I do a 2-hour quickie for the nurse residency program about the value of financing nursing. Something as simple as supplies, as we talked about. Our choice to get that extra Jericho or that extra set of 4x4s or whatever it may be, and we have a certain supplies wastage. It may not seem like it's much individually. When you add that up over a system this large, it makes a difference. How we manage to census on a daily basis but maintain that balance with what we're trying to accomplish clinically makes a difference. Safety, right? Keeping patients from falling, because under the value-based proposition, if a patient falls, who eats the cost?
We do.
Another does. That's exactly right. Whether it's 10,000, if they break a hip and we're out $100,000, we're out $100,000. Patient flow. Now I know there's a lot of extraneous factors around patient flow because my wife and I were talking about that the other night. But under the bundled payment premise and value-based reimbursement, in your world around MIs, what's the expected length of stay for a non-complicated MI in this day and age? 48 hours. So if they stay 72, we get paid for 48, right? Same premise. So every activity is connected. As I've told you, it is the language of senior finance. When I have conversations with Jay Ham and Greg Gatman and Ms. Keeney now, whoever it may be, or anybody, and when I have a conversation with Sean Patton, they're always talking in finance vernacular. And it's important that we as clinicians, I can tell you as an EMS director early in my career, I had a distinct advantage going into meetings with my county administration. And then as a hospital director again too, I had a distinct advantage about things I was asking for because I could understand the basics of what they were talking about. You get that inside edge. As we continue to look at how we balance this equation from a practical professional development standpoint, having this understanding, when you're going into a competitive interview process, you want to become a director, system manager, director, whatever that next step is, CNE, this is where that advantage is in that regard. You get to convert this stuff into action, as we've talked about. Having that business acumen that supports these strategies allows you to marry these two things together in a balanced manner and to convert it into action for your units and your patients. So here's some leadership roles to kind of give you an idea of what people do. So here's Sean Patton. He's our system controller. You have people that handle financial accounting, managerial accounting, tax accounting, the patient accounting or the revenue cycle process, and then internal auditing. Those are all the things that he'd be in control of. As an example, what's the difference, and this is where the vernacular comes into play, what's the difference between financial accounting and managerial accounting, fundamentally? Anybody know? Financial accounting is the external reporting process that we'll talk about in a minute. There's the financial statements that are in your packets. Managerial accounting is fundamentally cost accounting, the internal measurement of the costs within the organization that ultimately end up on the financial side, but have to be measured specifically and uniquely away from the financial statements before they go on to the financial statements. So that's an example of the difference. Tax accounting is exactly that. This is very important. Why for us? Because we're not for profit. How much do you think we save annually in terms of tax status? And this was a big issue in the Trump redesign of taxes. It's between $50 and $100 million in federal taxes. So you tack that on to where we kind of saw where we were, and not-for-profit status. If that changed for hospitals globally, you'd probably see most critical care access not-for-profits, the Kershaws and the Fairfields and the Orangeburgs and others in the world, go away. Will be absorbed in some form and create huge holes in our care network, even in South Carolina. So that's a big deal. This is revenue cycle process here for accounting for the patient revenue in there. And then we have an internal auditing group that I actually work with quite a bit. Has anybody ever worked with internal auditing? Don't count them as your enemy. They're your friend. They're there to help you think about process too. We used to work with them when I was in business support in women's services. We'd come in and we would look at the financial pieces, but we would look at their process around certain things to make sure it's a good process and it has the right checks and balances in it. So the treasurer works with our working capital. The big thing is our investment portfolio. if you look closely, and we'll look at our financial statements, what's propping us up right now? That. I'm telling you right now, we're in a solid financial position, but like everybody else, given our cash position on the working side, as we'll talk about in a minute, if that tanked, if the stock market crashed right now, we're in trouble because of where we're not on the operating side right now. And then they manage the capital financing, and we'll talk a little bit about capital budgets tomorrow and how that functions. Because you do need to, as managers, I'm going to go into probably more detail than you want on capital budgets, but you need to understand how they rate capital budgets. So when you're submitting something and you're in competition for limited dollars, how do you get what you need from an ROI perspective? So I'll show you how that works. Corporate compliance, they do compliance reviews, problems of fraud and abuse. They look at this issue very closely about relationships, particularly in contracts. This is always examined as we do contracts. That's why you'll never see Palmetto do big contracts with family members of other employees because of the potential for impropriety here. And then again, the internal audit. There are employees that protect the assets from fraud, error, or loss. We do a form of internal audit in my group. What would that be? Oh, you don't know, because I haven't had to call any of you. I audit payroll. Randomly, I'm looking for, are we in compliance with payroll rules around premium pay and all those other things? So we're in somebody's time card all the time. Probably more than I ever wanted to be. But we don't.
No, really.
The big issue here and why all the finance positions, and we actually have contracted some of, as I told you, in certain areas, contracted some of that as a response to the changes around our cost structures and everything. My finance professor once told me, probably the best information I ever got, if you want to make money, you got to spend money, right? But you better spend money wisely. And that's the point here around the cost of these programs. The overall cost from an ROI perspective of these programs is far less than the long-range risks if we weren't looking and managing these issues around tax status, proper revenue cycles so that we don't get in trouble and have our Medicare or Medicaid taken away from us because it would close our doors. Fraud around contracts and impropriety around being sued for a multi-million-dollar contract, patient falls, HIPAA issues, all of those things that would harm our reputation as an organization and so forth. So it's a much better plan than the cost of income or comfortable inaction. It's easy and comfortable to do nothing and hope for the best in that regard, right? That is a sure pathway to a problem downward. All right, so some terminology. So to get you started, we've already kind of alluded to this. Fixed cost, they stay the same irrespective of level activity. We are all fixed costs, no matter what happens. Okay? Variable costs are your nurses and your techs and anybody that you would vary based on census. That also is your supplies fundamentally. Supply costs vary by virtue of that. Actually, other things will vary to an extent around that too, such as power consumption and other issues around that, because if we shut down half the hospital and turn power off to it because we're not using it from a census perspective, you can step down a little bit what is otherwise normally a fixed cost. Step costs, changes up or down at certain intervals. So here's my first trick of the day. Are your budgets a step cost budget? The budget grids that you guys work with, think about them fundamentally and what they do. Actually, they are. Well, no. If you go up your grid from 1 patient to 30, you go in increments, same level of nursing in increments of 3 to 4 to 5 patients.
Right.
Then you step up again, stay the same, step up again. That is fundamentally a step cost budget. Because you have intervals where the input stays the same and then jumps again based on that threshold change of a patient census, right? That's what I'm talking about in terms of step costs. They change at certain intervals.
So like every 5
Every
patients,
3 or
then
5,
we
it
would,
varies based
I'm just
on
saying,
what,
but
yeah, every 3
so
or
every
5
5
patients
patients,
it
you would
changes.
change
the problem with that fundamentally, as we'll get into later on, is that it puts you at a disadvantage because it depends on where on the hill you are.
Right.
Because your starting point could be 102% productivity, or it could be 96% productivity in that range, right? So as we've talked about a little bit, I think you started out at 98 in our conversation, so you're already at a 2% disadvantage before you ever open the gate for the horse, right? So that's that kind of concept. So cost estimation, we do this in terms of past performance predicting future performance. I think we can do a better job collectively as an organization. I'm going to show you how to help do that. You have to look at past performance to separate out the mixed costs and then estimate future costs. Mixed are a form of both fixed and variable, i.e. the light bill. So when you do budgets, you're focused solely on labor, right? Because that truly does change variably based on your ratios and your worked hours per patient day. Inflation, that's one of those things we're facing. Mr. Beeman talked about that. Got that problem right now that we're trying to correct. What is one of the biggest points of inflation for us as nurses? Because of where we are globally in the nursing environment.
Being in the side.
Strategy around salaries, because there's not enough nurses. There's only a couple places where there's too many nurses, Ohio being one of them. So if you know anybody that's in Ohio, don't come down here. I'm just saying, because it is a state where they have too many nurses. There aren't many like that. But that's part of what is driving that supply and demand of cost, because the nursing schools can't put them out fast enough. And that's why we talk so much about 2-year retention and trying to improve that. Because when you turn over a nurse, it's 25 to 30% or better of that salary in the turnover cost on top of the next salary when you start looking at that. All right, this is extremely important right here. And we're going to talk about this in the financial position. Just like you have a credit rating based on your financial history, we have a credit rating based on our financial history and that bond rating that they talked about the other day. Our problem right now with the BBB rating is that it's costing us probably several $1 million in extra money per year in debt service because of the interest rate associated with that. It's no different than you having a fair rating versus a good rating. You're going to be charged an extra percentage point on your car loan because of that, right? Same premise in this, based on the financial position of the company that we'll talk about. We all know what revenue and expenses are. That's pretty self-explanatory. Yes,
I'm
ma'am.
sorry, just a
Go
quick
ahead.
question. So was that when they went over in LI the other day, and they were saying that like we look good from 2 different organizations, but one of them, I
It's
can't remember
slightly
the
off,
one.
yeah.
Yeah, is that?
That's that same premise, because think about you personally. If you look at Equifax and you look at Experian for your personal credit score, they're going to be different.
Right.
Because they have a slightly different methodologies to kind of get to where they think you should be from a credit risk standpoint. And that's where that comes from, that's correct. So you always see that. You want it in a general range. For best bond, you really want an A- for best bond ratings. And we're at a BBB plus right now. So we are just below that threshold. That means significant money in terms of differentials on your debt service. So we're talking, for this company this large with as much as we have financed, it's a few $1 million a year. And when we're talking about an NOI or a contribution margin of 1.25% or $13 million, that adds up a hurt on the bottom line. So it's these little things that we talk about. And that's why it's important as you as a manager to understand this, because the things we do translate to that fundamental. All right, FTE, we know what that is. It's a full-time equivalency. We've already kind of talked about flexible and variable budgets. They are adjusted periodically based on the changing in volume. So there, you can change volume on a unit, or you can change the workload input because we learned something from acuity, or any other factor that would go into that budget calculation. My favorite thing is statistics. Who's the statistics geeks like me? Actually teach statistics at the undergrad level.
As soon as you said statistics,
I cringe.
Everybody my favorite class of all time.
I got it out by the skin of my teeth. Okay, that's fine.
But it is very important, because what I'm going to show you tomorrow is we're going to show you trend, but you need to understand some basic statistics around variance, min-max, mean, median, and mode to help you understand kind of the why behind the data we're looking at from a predictive standpoint, because if you don't understand how much variability you have in that data, you may take a risk that you otherwise wouldn't take when you understand it. For instance, anything from a variance or standard deviation standpoint that's more than 50% of the mean or the average, I get real conservative because you got a lot of this around your average. Okay, so when you try to staff tight to that, you're going to end up understaffed, as an example, if you're not careful. Outpatient equivalence is the calculation of outpatient activity or volumes. Adjusted admissions, that accounts for your inpatient case mix index factor. You guys know how we admit on level of care now, right? Around our charges. That's all this is right here. If you hear that vernacular, that's what we're talking about in adjusted admissions. Patient class is that category. So are they inpatient, outpatient? Or are they critical care level? Or are they, again, goes back to the level of care. Okay? So let's get to accounting fundamentals. I always have to throw in a funny cartoon. I love cash flow that gets in my bag. It doesn't work like that though. There's no magic, we did that magic thing where we could pull the string and all that money flow out. Every Thursday before payday, my basket is dry. I'm like, where's this string? All right, accounting. I want to show you the framework of how we get there globally. So when they talk about accounting and balance sheets and income statements or operating statements, what does all that mean? But I also want you to understand fundamentally some few key areas as we'll go through the financial statements in a minute of how to read where our position is as a company and how strong we are in certain areas, because it does strategically flow down to what we do on the units. So the process of governance, just like we have joint commission, right, that governs what we do as a hospital, accountants have a governing body in the Financial Accounting Standards Board. They were created in 1973, and they were created because, quite frankly, widespread fraud and abuse in the accounting world. You've ever heard a statistic is just that, a statistic, it's easy to manipulate a number, you can make it say whatever you want. It's a problem you would have seen in accounting in terms of definitions around whether it's inpatient revenue, outpatient, is it a fixed cost, is it a variable cost, what's its tax status, and so forth. So you have a set of generally accepted accounting principles, i.e. when income is realized. Is it a capital expense or is it an operating expense? What's the threshold? What's the timing of when you do certain things? And that's what's wrapped up in all of these principles. Now what happens with that every year, we have our financial statements externally audited. So an auditor gets paid quite a bit of money. They go through our statements and they say, yes, you're going to get an unqualified opinion, is what is termed, that these statements are a fair representation of the actual activity based on the generally accepted accounting principles as promulgated by the federal or the Financial Accounting Standards Board. Right? We've heard that kind of before. That's where all that kind of comes from. So some GAAP principles. These are some basic principles that we have to be an entity that is the focus of attention, i.e. Palmetto Health as a whole. Now there are subsidiaries, i.e. the medical group, right? It is treated as a separate entity within this process under the accounting principles. We have to be considered a matter of ongoing concern, i.e. we're going to operate our doors, we're going to open our doors and keep operating year after year. There is a different process if we were going to close the company under the rules. There is a matching principle. This is very important in what we'll talk about in terms of accrual versus cash accounting. Those are two separate forms of accounting. That if you record revenue, all expenses associated with the generation of that revenue also have to be recorded as part of that process, and vice versa in the same year. So in accrual accounting, as we'll talk about, we have our fiscal year of October 1 to September 30th. They say I'm cutting it off, and you get that notice that say any expense is being cut here. That's where this matching principle comes into play, because you generally already realize the patient in terms of the revenue associated with it, and we've got to match that expense in that year to close the books. So you have a cost principle. It has to be the amount the organization actually pays to acquire the resource. You cannot artificially inflate costs on the books. There are reasons from an accounting perspective you would do that to dumb down revenue if you're trying to pay not pay taxes. No different than you underestimating your revenue at home or overinflating certain expenses on your write-downs. Kind of the same principle here. It has to be objective. In other words, it has to be independently verifiable. If an auditor comes in, I got to be able to produce that receipt. It has to be material, and this is very important. Okay, materiality is relative to the overall cost structure and budget of an organization. So in our organization, is a single pen material from an accounting perspective in a $3 billion organization? No. No. Is the cost of an MRI machine in our organization material?
Yes.
Yes, because it's several $1 million. That's the essence of materiality. It's a little bit of a moving target to an extent, but it's generally relative to the overall cost structure of the organization and the overall budget of the organization. It has to be consistent in the choice of method. We actually use two methods of accounting. I talked about accrual and cash. We do cash accounting from an internal control standpoint, and I'll talk about that a little more in detail. We use accrual accounting to report publicly the financial position under the rules of our company. And I'll talk about the differences in a minute because they are very distinct, but they're very important. Just like you at home from that standpoint, you know when your bills are due, but there's going to be a timing mismatch between when that paycheck's coming potentially, right? That's the fundamental difference between cash and accrual accounting. You're already accounting for the fact you have to pay for that bill and it's due in that month. But you may be due on the 15th and you don't get cash until the 20th, right? That's that difference between accrual and cash accounting. We'll talk more about that. You have to fully disclose everything. So if I were to show you the entire financial statement document, it's about 80 pages. There's actually 4 documents that surround 80 pages in the disclosure every year of our company publicly. The rest of the information is all of the explanation as to why those numbers are what they are. So that if somebody wanted to read the prospectus of this company, if we were for profit, you were going to invest, I would be looking at this prospectus and that to determine that they're doing things fairly and that I have a position of reliability to spend my money on whatever they're doing. You can do that the same way because what do? Fundamentally, we sell bonds as a not-for-profit. Same premise. I'm going to read that document if I'm going to invest my money because I want to know I get my money back. Okay, so everything has to be disclosed. All right, cash accounting. In this criterion, and this is our internal process that we use, it's the sole receipt or disbursement of cash is the sole criterion for when it hits the books. Okay, irrespective of when it was earned. So in theory, let's go back to patient care. If I take care of a patient today, the patient has baby on Tracy's unit, but she doesn't pay me under cash basis accounting until 2 months from now. When did I earn the revenue?
2 months.
2 months from now when she paid me. Okay, that's the fundamental of cash basis accounting. The problem with cash versus accrual is that we have to have cash flow to pay the bills until the actual revenue comes in, right? And that's where this becomes so important in looking at both sides. We do cash basis accounting because we have that disconnect just like your personal checkbook, because when Tracy's patient has that baby, it may be up to 6 months. If there's an issue around billing, for whatever reason, they dispute the initial claim, there was some kind of complication, they didn't want to pay for it, before we actually see the revenue.